Hello, my name is Tory Meiborg and I'm the president of World Trend Financial. In October, markets experienced a significant increase in the amount of volatility. Some markets around the world actually reached correction. A technical correction is a drop 10% from highs to the lows. Many factors were cited for the sell-off. Number one, falling commodity prices. Crude oil prices dropped almost 25% over the span of 3 months. Number two was ongoing economic concerns in Europe. It appeared for the third time in 7 years the economy may be poised for a recession. Number three, an escalation of terrorist threats out of the Middle East. And number four, and probably most importantly, was the concern over the spread of the Ebola virus. All of these factors, and others unnamed, were probably partially responsible for the sell-off. While this sell-off was not enjoyable, on a historical basis, it was not unprecedented. Over the last 110 years, the S&P has averaged one correction every 12 months. Since they avoided a true technical correction this go-around, we now enter our 37th month without such a correction. So why was investor reaction so disproportionate to the actual investment losses? We believe there are two primary reasons. Number one, investors, buoyed by 36 months without a technical correction, have become somewhat complacent. Reason number two, we all recall the period from September 2008 through February of 2009 in which the market dropped 42%. As a result, every minimal pullback makes investors believe a larger drop is coming. But in truth, the likely scenario lies somewhere in between. A 10 to 20% correction is coming, it's just a matter of when. But if we follow a disciplined approach, we'll be able to weather whatever the market may have in store. At its most basic, our disciplined approach is comprised of 3 points. Point number one, money needed over the next 5 years should not be invested in equities. Point number two, monies needed beyond 5 years should be invested with an equity focus. Number three, equities should be diversified outside of just U.S. large caps. While they have been the best performers over the last 5 years, that does not necessarily mean they will do the same in the future. In addition to ongoing volatility in the equity markets, we are quickly approaching the end of the calendar year. Now is a great time to contact your advisor to discuss not only your asset allocation, but important year-end tax planning steps. Please call our office to establish a convenient time to meet, and we look forward to seeing you soon.